about the market pulse, that is the market analysis. What we had done just in our last session was that technical analysis. We had done the technical analysis of this Nifty, how the Nifty will go, which are the top stocks that we look forward to in this coming week. That's the week starting around 9th of September 2024. But having said that, we have seen Nifty falling because on the backdrop of the risk about the jobless claims data that the US is expecting, and that is around Tuesday or Wednesday of the upcoming week. But having said that, it is not only the Indian market that have corrected, it is globally with the European, Asian or the American markets. The indices have fallen broad based. However, while from the recent past of the last 6 to 8 months, we have known and we have seen that the stock specific bull run story has been quite evident in the Indian markets. But with this thing coming up, since the broader markets would be falling, we will be seeing bloodbath in the market. But that's not bad in a sense that much of the many overvalued stocks will get trimmed down, and therefore the point of re-entry would be made, and it will mellow down the riskiness that is inherent in the market. But having said that, in this presentation, I will just show you how many times it had happened in the past in this 1 year itself. So there much of the worry is unfounded for that matter. But while as an Indian investor, what we have been doing, we have been seeing into the news, we have been seeing the graphs, and we are looking at Indian markets in isolation. What we would be doing in this video would be, we will be looking at different aspects of the Indian as well as the global economy, and then we will see how to tread the path in the upcoming week. So without losing much of the time, let me share with you the screen so that we can begin with the main core content as we see it. Yeah. So here it is the weekly analysis we are doing as per part of our market pulse. Standard disclaimer. Market overview. So here if we see, this is the broader market overview as we see about the various exchanges around the globe. Now if we see it in the interactive platform here, okay, so now here if you see, Sensex has fallen by around 1.43%, but if you see it, it is about the daily graph, and it is from the August 30 to September 6. So from August 30 to September 6, as we see that this is the status of the Sensex. Now here in the same, if you see that global indices have fallen more sharply than the Indian indices. So that means even if while everybody is saying that the Indian market is quite overvalued, Indian market is quite overvalued, however, because it is a global phenomenon limited to US markets, yes, because the funds, because when there is a broader pessimism into the markets, the funds flow out from the economy. So whether that is an Asian or an Indian or a European or an American for that matter, but the quantum with which the outflow is happening, or the fall, the spectrum of fall that we have seen in the recent past in India has been less as compared to the other economies for that matter. But if we see say how the 10 days go, this is how it is, and if we see how it has been on the quarter levels, so this is you see in the quarter level, and at the quarter we have been around 2.72% up, whereas the Dow Jones had been around 3.14 up. So this is how it has been. But if we see Chinese economy have been actually in the doldrum. So having said that, if we see this as our first attribute globally, we have seen that Indian markets have not fallen. Indian markets have not fallen to the same extent from the 30th of August till date as other global peers. So therefore, one of the thing here is taken care of. Now, then the second part here comes is if we look upon the weekly trend, how the week has fared, and if we look from the market capitalization and we are looking at the Nifty 50 stocks. Here we are seeing that the Reliance has corrected around 4.51%. So if you would see that if there are heavyweights, those are the heavyweights. If they are into the red, then obviously it will impact the broader indice correction for that matter. But if, for example, we are looking at financial, yeah. So here, if we looking at finance. Here, obviously, Bajaj Finserv, Bajaj Finance have been like quite good, including the SBI Life in the past week, including the Shriram Finance that had supported it. However, if we see the energy, minerals, and broader petrochemicals and all, we have seen that they have fallen quite a lot over the week. So therefore, there have been isolated, you can say, islands where the main selling has been seen. So if you see the technology services, we know that the technology services must depend upon the US markets and the global. So here if we see around 2% fall in the Nifty happening, and then you have the TCS, HCL remaining nearly okay. Wipro has seeing a fall, including tech for that matter. But here on the automobiles, we have seen Hero and the Titan being in the good. Sun Pharma had been doing good. Process industries had been good for that matter. Here Grasim and 2% Ultra 𝐷𝐚𝐿 and the Hindustan Unilever. Now we know that these are defensive. So if you see the consumer non-durables for that matter, or FMCG, if I may say, FMCG. So these are much of the resilient companies which don't give you the exorbitant returns, but yes, when the markets are down, they provide much stability to the portfolio as you see it. So here we have seen that which have been the main drags. You have the 8% falling of the coal, you have the 7% falling ONGC, BPCL falling by around 2% for that matter, Tata Motors by falling by around 5.5% over the last 1 week. So these are the islands where we have seen in the week's time there has been a substantial fall happening. Now, when you look at this perspective, we have also to see how the different sectors have performed. So here we will see how the sectors have performed and how sectors have been seen. So now, if we see here from 1st of September, here we are seeing at FMCG. So this is the FMCG. We have seen around still being at the par. Then we have the pharma 0.66% down, services down. Then we have Nifty mid caps. And then we have seen around 1.15% down since the 1st of September for that matter. And obviously the rest of the stuff is falling. So if you see the major chunk that has happened, the major chunk that has happened, this is the major impact. So major impact is in the energy stocks. The energy stocks have gone down, the metals have gone down. And now let me tell you, when you talk about the commodities or the metals, it is not only the metals segment in India that has fallen, it is in the global parlance it has fallen. And that I will also show you further in the video, how the commodities have traded over the globally for that matter. The infra has taken hit and auto has taken hit. Now auto, we know that there are heightened inventories, and they are still lying there for that matter. So other commodity segment has also taken a plunge. Now we will try to just see how the different indices have interacted over the past for that matter. Now here if we see that from the July we have seen that the auto has gone up by 70%. Now if I try to zoom in like this, the auto from say November 2022, we will go to Jan 2023. So if we go to Jan 2023, we see auto being up by around 100%. But if you see the stream of the fall, that is more steeper than the others. The auto has seen exorbitant right. So many times it is also very good, because when you're having a stock portfolio or when you're having a thematic mutual fund portfolio which might have an exposure to a certain segment for that matter, and now if that sector is under stress, you have to see these as an opportunity or as an instance to realign your portfolio or asset allocation. So if the auto stocks are under the stress, then you can think about shifting those stocks out of the auto segment to something else. Now if we see from the Jan 23 to 24, that means 1.5 years, it has given 102%, 85 Nifty mid cap. But then these are the mid cap stocks. If we go on the sector for that matter, the pharma has given 82%. Now if we try to zoom this further, and we try to go here, and we try to go 5 minutes. So this is the September. Now if you see this, here we are 29th of August. We had been 29th and 30th of August. Okay, this is this. Here you see FMCGs 0.24 up, then we have the pharma being down, and the much of energy and the metal. Here you are seeing how they have the trend. Now if here if you see, even auto has been down 2.5%. Now if you see on a short term basis, now if you have taken a position in the stock, now what you might have entered into a stock seeing that okay, the auto segment over the last 1 year has given, say for example, 100%, I need to get into the auto stocks, I need to get into this. But if you see from the short term perspective, you will see it is one of the most fallen category for that matter, and that is one of the main precise reason why it is said that it is not worthwhile to gauge the past performance and then get into the stock, because then you are actually entering late and you might have already missed the bus, and for that matter, so and rather got into the wrong bus and the wrong heading to the wrong station for that matter. So this is one of the things if you look at. Then if obviously, and if you look this and then you see okay how that current upcoming the markets would be there, then if you can see the Nifty, and the Nifty has been taken a fall recently of around 1%, but that is not the only fall it has taken now. If you see, there has been fall in around 1st of August, there has been fall around 19th of July, there has been fall around 6% in the month of June, there has been fall around 3.5% in the month of May. So whether you talk about May, June, July, August, every time there has been fall of 2 to 3% or 4%. So matter of fact is, and really big falls, and even after the big falls, the market has jumped up. So what is more paramount here is to know not the fall has happened, but why the fall has happened. Whether that is inherent or the reason being inherent to India that the fall has happened, or the globally. If the jobless claims data are there, if there is an issue, then obviously the US government will be under pressure to literally reduce the rate of interest. The only thing will be that inflation, if it is under control and the US claim jobless claim data is high, they will be forced to cut the rate of interest sooner than later, because then they will have to support the industries and the companies over there, so that the hiring can be restrained, or the numbers should be on the positive end of the spectrum. So having said that, inflation is more risk, I would see, than the jobless claim data, because if the jobless claim data still do come in with inflation still under control and at a very good level, then we can see faster execution of the rate cut. If that happens, that will be good for Indian markets also, and the long-term bond yields also for the matter. So coming back to the presentation, if we see that currencies, if you see the currency, how the currency have been doing in the recent past, say from the 1st of August till now, we have seen that USD Japan, USD has fallen by around 1.33%. But having said that, USD INR has been stable. So therefore, we don't have to be too much worried about it, because the Indian market, because currencies and the stock markets are inversely proportional. So that is quite evident, because Indian markets have been doing good over the last 1 month. So therefore, we can also see that translating into the currencies for that matter. So therefore, next comes to global bond yields, how they have been doing. So if we see here, this this is the gray one. This is Indian 10-year bond, treasury bond. Of India. Now, if we see this, the long-term interest rates of the 10-year treasury yields are around 6.851, and the 1-year yield is around 6.835. So this is still okay, because the long-term bond yields being higher than the short-term yields is always good. Matter of fact is because this shows that we expect market to do better, the yields to be good at the longer end of the spectrum. However, if it happens the other way around, the shorter-term interest rates being higher and the longer-term interest rate being lower, then that means there is a reversion of the bond yields, then that indicates technically in certain parlance by some of the analysts as a recession and not good for the economy. So long-term bonds being higher, giving the higher yield than the short-term yield is a good sign of indication as of now. But however, if you see the same in terms of the US, the 1-year interest rate is for 4.095, and whereas the 10-year is around 3.713. This is much better than what we are seeing in India. So this, if we see here, now this we have seen from 3rd September to 6th September, but here if we see, say for example 1 month, So here you can see these are the differences. So here if we see quarter, 6 months, so there has been good spend, but however here we will be seeing that our 1 year yield is catching up with a long term yield. So therefore this is very important and pertinent that there is the RBI reduces the rate of interest. If the RBI reduces rate of interest, you see the yields jumping up, because that has to be the gradual transition of how it should be, how it should be. So therefore now what is important, based on if we add the one and are seeing that what is the 1 year and the 10-year yield, so what it translates into, what is the yield spread. Though if we see here in the US between the 30-year and a 10-year there is 0.3 percent, 0.3%. But if we see the same for the Indian treasury yields between the 30 and the 10-year treasury bonds, it is just 0.274. So therefore it is not that good, but US is much better place in that parlance. Again, if we compare then 10 and 2-year, then it is 0.059 for US, but it is negative for India, which is not good. That means that the 2-year bonds are giving you better yield than the long-term bonds. This is not technically sounding from the fixed income market perspective. That means if that means the people are not favoring the long-term treasury bonds technically for a yield. So therefore that means there is not too much of confidence into the treasury bonds to invest into over the longer term, and for the short term change the money is being kept into the short term bonds and then being circulated for that matter. So therefore for any economy it is always good that the long term bond yield should be better than the short term bonds, and the spread should be positive and rather not negative. So therefore this comes us to the next element of no, when you're looking at these perspective, when you're looking at your stock market perspective, you have to see how the bonds are transitioning, how the rate of interest are transitioning, how the global indices are functioning. Then you can make a prudent decision. Okay, if bonds are going this way, or if the stocks market is going this way, bond is currently at X scenario, so therefore we expect this to go up or go down. So therefore you can then juggle, or you can reorient your holistic portfolio that is a part of both bonds, stocks, and other assets. So therefore coming down to the commodities part. So now coming down to the commodities part, we have here. So here we have seen, say from the July part, we have seen the gold going up by around 7%. We have silver at around 6.25%. So therefore if we see as what we say that silver ounce, this has been as a part of USD, it's around minus 4.1%. Coal, this is actually coal. We have seen coal going up. So here we have seen the price of gold going up. We have seen the coal going up, and or on the other hand, if you're seeing less, we are seeing as silver. We have seen copper. We have seen crude. That is the reason why energy companies or the petroleum companies are falling more steeply, because their profit margins would get capped. Crude, and then we have this one, crude, this, and then you have natural gas. So this is natural gas, this is crude. So we have seen that now crude itself has fallen by 16%. Damn, it's good. Now obviously so therefore if you could see that those companies, not petroleum companies for that matter, but the companies who use petroleum products, like there used to be one company called as the Philip Carbon for that matter, or the tire industry for that matter, or even the paint industry for that matter. So if the crude oils are falling down, if all other factors being normal and the natural and no other bad news happening, so if the crude prices are going down, we can see those stocks going up. However, if there are energy companies like BPCL or HPCL, we can see them going down because their profit margins will be down, because there's a falling in the price, unless until they have certain agreements well in the place which have insulated them from the price fluctuations, because many a time they do the futures contracts in order to preserve and protect them from the price fluctuations having in the global market. But when the global crude prices go down, there is a political pressure also in India to reduce the price of the crude and petroleum products. But if they don't reduce it, then they're obviously the revenue numbers will stay there. But if the numbers go, if the price has to be reduced, then the revenue numbers will show dip. So that is the reason why it impacts on their price on the short term basis. So this is one aspect of it. Now, when we come to the world macroeconomics, we also have to see, okay, we have seen commodities, we have seen currencies, we have seen how the bonds have happened, we have seen how the stock markets have traversed. But where in all these scenario, where we are and where are the global firms from the macroeconomic point of view. Now here, if we see that we are here, and what we are concerned about is how the US is doing now. US GDP growth rate quarter on quarter is around 3%, but in our case it's only 1.9%. If you see year on year basis, so that means in the recent quarter they have shown grown up, and I believe this is one of the reasons why, with inflation also under control, and with better economic or improving economic scenario, they are very much optimistic about getting the rate cut. However, over the year-on-year basis, while the GDP growth rate has been just 3%, in India it has been around 6.7%. In inflation numbers, they are at steady 2.9, we are at 3.54. And if we look at industrial productions, they are bad at these numbers, where we were okay at 4.2, but what is much more important in knowing the PMI or industrial production, we also have to see how they have been doing swing a month on month basis rather than year on year basis. Policy rate, they are at 6.5, our repo rate is around 6.5. So we are awaiting once the RBI, once the US starts cutting the rates, the RBI would be the first one to do it. 10-year yield they are having is around 3.75, ours is at around 6.8, and their debt to GDP ratio is around 122% of the government debt is 122% of the GDP. They are overshooting by 20%. However, we are maintaining at around 86% of this. So current account deficit, if we look forward, is that we have been at minus 1.2% right now. The change that has happened, and its jobless claim has to be seen recently. Over the last data available with us around a month back, it's around 4.2, and for India it's around 9.2. So these are the things. We are not very much looking into cross comparison with other broader economies, but we have to see how we are in relation to the US. China itself is not doing much good. So and obviously it won't be impacting Indian economy directly as the US market, because the US rate change will actually determine the flow of money from the equity as well as the government debt markets, as we see. Now when we come all to this, now this comes, okay, now we have everything else in our head, currency, commodity, and all those things. So where does Nifty fall? So if we see from the broader perspective, our macroeconomics are in sync, our currency is stable, our commodities that have seen a fall. We have seen coal and gold being up, with all other commodities being down. Now this also shows that there has been a global slowdown in the economy, because the commodity prices are down, and that is primarily on the backdrop of the demand from the China has been less. Now if the demand from the China would increase, then obviously the offtake would be higher, and we can see the upswing having in the commodity sector. However, now Indian companies which are based on these commodities, who have these commodities as an input, they would see their margin expanding. So therefore the point is to identify those stocks which would gain benefit out of it. So this brings us to the last and final section of the Nifty technical analysis. And while we have already done a separate video on the Nifty technical analysis, I will be posting that as a comment to it, but broader thing I will be mentioning here in short, so that you have things to take care of in terms of what are the stocks we are looking at, what Nifty levels we are considering at, how much serious is the current market fall as we are seeing globally as well as in India. So these 2 or 3 couple points quickly I will be taking it. So now if you see here Nifty, just a second, okay, this. Now if you see here the Nifty, here say in the month of July 24, around 24, the Nifty had fallen by around 3%. Then we have seen in the month of again June, it had fallen by 6%. Then here it has already fallen by 3%. Primarily, if you see that it has been around in the opening month, it had been down. Now, since in the opening month it had been down, this shows that us one of the most important things. Say, for example, now it shows us the one of the most important things, that every time the market has gone down, it has gone up, and it is primarily because of the US job loss data, if nothing else. Either it had been because of the elections or it had been because of the budget, but majorly whenever there has been a global turmoil or volatility because of the US jobs claim data, the Indian market has corrected. But one thing is for sure, over a longer period of the time, it has gone up. Now, however, if you see the technical parameters to it, only the sell signal as of now has been there in the moving average convergence divergence, MACD. The MACD 1226 is providing a first red histogram, and we are saying that this is a sell signal. However, if we see broader percentage R and Fisher 9, it had given already a sell signal a day prior, but many a times it is we have to see a confirmation signal, but this can't be seen as a selling. Is that okay, it has fallen off from its overbought situation, or it has been at the most bullish or overvalued situations coming down, but it's not a confirmation for that. Many times it is a very false indicator also. So the main point is, if it has fallen from here in this case, if you see this red line and this orange line, which happens to be the EMA and MA crossover, that is exponential moving average and the moving average crossover, this crossover is not crossing down. So that means this has not generated the sell signal. So this has not generated the sell signal. So therefore, only the one signal has been there. Secondly, if we see the Fibonacci level, from the top, it is going down and it is touching the Fibonacci level of around 0.786. It has not breached it. It gone down, then it retraced back. Now, the matter of fact is the change in the job loss data that is going to come up would be around Tuesday night or Wednesday. So the other 2-3 days. So we are looking at the heightened. We're looking at the heightened volatility happening in the upcoming week between Monday and Wednesday, and there might be quite range bound, volatile, oscillatory swings into the markets. But having said that, the first strong support level as we see would be at 0.618, which would be approximately 24,649.94 the Nifty, and if it reaches that, the next level would be around 24,504. However, we see this is a very strong support level, and from here it should technically be coming up as it goes. Now, this data, as we are seeing, that is on the daily. We have not seen weekly. So if you see that only one signal, if you see parabolic SAR here, these dots, the parabolic SAR has also not given us sell signal as of now. So short term, we are not seeing it. Maybe the market is still waiting how good or bad news would be there, other than the job loss claim data that's expected on Wednesday. What other news can come on Monday, Tuesday, that will determine how the markets will behave. So if we see on the weekly data, you will be surprised to see here, you see this. None of the signals have given, rather this one is still showing bullish over here. So none of the parameters here is showing a sell signal as of now. Again, it is again at the same stronger level of 0.786 as we see it. So we are not seeing any broader weekly fall data. So there's a lesser probability of the fall extending on the weekly basis for a couple of weeks. We don't anticipate it unless and until there is not any geopolitical bad news happening, apart from the bad job loss claims data that might come up. So therefore, and these falls, if you see this 1 week, every candle is 1 week. So this fall is last 1 week, this fall is 1 week, this fall is 1 week, this fall is 1 week. So if you see that, here it had been the only case where there had been the 2 weeks of the substantial fall. Here had been 2 weeks of substantial fall, but then again it went up. So the matter of fact is, when you're looking at anticipating that, okay, the market is going down and we will be losing money, and there's all those news channels pumping out the fearful stories on there, you have to put your brains together based on all macroeconomic factors that how it will go. Now, the matter of fact is, the broader indices might be down, but there are still stocks which are showing promising returns. If for the next 2 or 3 days no bad news comes, then we can see some good stocks going up, but it is based on just knowledge or information that I'm sharing with you. It might be different based on how the broad-based dulge or you see the bloodbath happens in the market. But otherwise, if everything goes hunky-dory, we expect Supreme, Philatex, this Ether to be some of the good ones at the very good levels. some of them even breaking their ranges, and might go up if the broader market supports them. This is what we anticipate. So this is very short. Just I have done a detailed half an hour video on the technical analysis, so you guys can see that as a technical analysis video. We have also analyzed particular stocks, these 3 stocks also, apart from the detailed Nifty analysis on the price level. Now, this comes us to the last section of it, which is the economic events that we should be very aware of coming this week. And so here this week, while there are many parameters that will be impacting across the globe, we are concerned about those which are in India and US. So here this week we are only expecting some good serious news announcements coming from the US. So here if you see at 1800 hours, September 11 core inflation data will be there, consumers sentiment. So therefore if you see that the core announcements that are coming up, the jobless claim data will be there, you will have the inflation data that might be coming up, because if the inflation data is right, if the inflation data is the forecast, they are anticipating 0.2. So if we are anticipating 0.2, if it remains the same or it goes down, then we can see the rate cut happening. And if that happens, it will be a very great short-term bull ride for the entire markets for that matter. So therefore the 3 dates you need to consider: September 11, 12 and 13. September 11 will be about the inflation data, September 12 will be about the PPI MOM, and then there will be a consumer sentiment as we can see it. So primarily it will be Wednesday and Thursday that we are looking forward to how the market transitions. So therefore, what an investor should do, an investor should stick to the basics, make sure that his asset allocation is right, should not be greedy enough, should have better assets spread across different asset classes. If the rate cuts happen, you need to be already present in the long-term bonds and the medium to long-term bonds. If you're not there, you will have missed the bus. It is just a matter of the time when the rate cut should happen, and it would happen, because it is a cyclical. If they don't do it, then the US would have to repay its debt at a higher. So either it will have to print more and more money coming forward, and its jobless claim data is also increasing. So there are many things that are coming up. So they are coming up. So therefore, what is imperative at our part is to see our assets are okay. Wherever you can do the profit booking, do the profit booking, park the profit in gold or bonds, and then get back into equities. You will get very good equity opportunities really coming up this week as the markets correct. And thank you so much. This is Rajat signing off. Thank you.